Welcome back to the deep dive. I have to say, looking at the setup we've got for today, I feel like we've walked into the study of a 19th century prospector who somehow got his hands on a Bloomberg terminal.
It's a very specific vibe, I'll admit.
We've got these vintage geological maps on the walls, chunks of copper ore sitting here on the desk, which are surprisingly heavy, by the way.
Yeah, they are dense.
And then right next to them, we've got these live ticker charts flashing on the screen. It's a very cool intersection.
It is, but it's fitting.
Yeah.
We are sitting right at the intersection of raw earth and high finance today. And honestly, that intersection is where the most interesting things are happening in the global economy right now.
Which is a fascinating place to be.
Yeah.
Because usually, when we talk about the massive economic trends reshaping the world, things like electrification, the transition to renewables, the absolute explosion of data center investment, we're usually looking at the shiny stuff.
Right, the tech.
Exactly. We're looking at tech companies, the software, the AI chips. We're looking at the cloud.
We are. And I mean, that makes sense because that's where you, the consumer, actually see the change. But today we're asking a completely different question.
Which is, how do you actually invest in those abstract trends without buying the tech stocks that are, already trading at 50 times earnings?
Precisely. If you strip away the software and the branding, what is the physical foundation of that future? The answer lies in the ground. Specifically, we are talking about copper and lithium.
The building blocks.
Right.
Because if you don't have these, you don't have an iPhone, you don't have a Tesla, and you certainly don't have a data center.
You have absolutely nothing without them.
But there's always a big but. Here, we have to address the elephant in the room immediately. Mining commodities are, well, they're a roller coaster.
To put it mildly.
I mean, if you look at a 5-year chart of lithium, it looks like a heart attack.
It really does. It is no secret that mining commodity prices are notoriously volatile. They swing wildly based on macroeconomic factors, geopolitical issues, supply chains. Prediction is just incredibly difficult.
Yeah.
And for a lot of investors, that volatility is a giant do not enter sign. They see the swings, they see the red arrows, and they just run back to steady tech compounders or index funds.
Right. It's scary, to wake up and find out the price of the thing you sell dropped 40% overnight. But that brings us to the mission of today's deep dive. We are looking at a stack of research that argues, despite the volatility, or maybe actually because of the recent volatility, there is an asymmetric value opportunity right now.
Asymmetric is the key word there.
And we're zooming in on two specific heavyweights to explore this, Freeport-McMoRan and Albemarle.
The argument from the source material is essentially that the potential downside for these companies, at their current valuations in early 2026, is significantly less than the potential upside.
Okay.
It's a risk-reward ratio that you just don't see very often in the broader market right now.
So heads I win a little, tails I win a lot. Or wait, rather, tails I don't lose much, heads I win a lot.
Exactly that. It's about limiting the blast radius of the downside while keeping exposure to a massive upside trend. It's about finding a floor.
Okay, let's unpack this. We've got a roadmap for you today. First, we're going to look at the Copper King, Freeport-McMoRan, and some hidden value there that isn't obvious on the surface.
Right.
Then we're going to pivot to the lithium comeback story with Albemarle. And finally, we'll answer the so what for you, trying to figure out where value investing actually sits in 2026.
Sounds like a plan. Let's dive in.
Let's start with Freeport-McMoRan, ticker symbol F-CX. Now, the sources call this a value stock right now, but usually when people hear copper miner, they think cyclical trap.
Oh, absolutely.
They think the economy slows down, copper crashes, I lose my shirt.
Yeah.
So why is this considered value?
It comes down to the numbers and specifically something called EBITDA sensitivity.
Okay, let's define that. We don't want to get lost in accounting jargon here.
Fair enough. Basically, EBITDA sensitivity is a measure of leverage, not debt leverage, but operating leverage.
Operating leverage.
Right. It tells us how much cash profit the company generates based purely on the price of the commodity they sell. Because a mine's costs are relatively fixed, it costs roughly the same to run the trucks, pay the staff, and run the crushers, regardless of whether copper is selling for $3 or $6.
So the overhead is just the overhead.
Exactly. So every extra dollar in the copper price flows almost entirely to the bottom line.
Got it. So once you cover your costs, it's pure profit. It's like if you owned a coffee shop and your rent and staff costs were paid for the month, every extra cup of coffee you sold after that was just pure money in your pocket.
That is a perfect analogy. And in every earnings presentation, Freeport actually lays this out. They tell you if copper is price X we make Y, it completely removes the guesswork for investors.
So let's do the napkin math here, because the numbers in the source material are pretty striking. We're looking at projections for 2027 and 2028.
We are. If we look at the company's projections, if the price of copper is $4 per pound, their projected EBITDA, which is earnings before interest, taxes, depreciation, and amortization, is roughly $11 billion.
Okay, pause there. $11 billion at $4 copper. But where is copper right now? Because $4 feels, I don't know, that feels quaint. That feels like prices from a few years ago.
It does. As of the time of this analysis, copper is trading significantly higher, around $5.66 per pound.
That's a massive spread. That's almost a 40% difference.
Huge. And this is exactly where that sensitivity kicks in. If copper hits $6 per pound, that EBITDA projection jumps from $11 billion to $19 billion.
Wow.
Think about that math. A 50% increase in the price of the metal leads to nearly a doubling of the profit. That is operating leverage in action.
But let's stick to the reality of right now. We aren't at $6 yet. We're at roughly $5.66.
Correct. So if we interpolate that, basically doing the math between the $5 and $6 guidance, a rough estimate puts their EBITDA at roughly $17.6 billion right now.
Okay, so they are essentially printing money. $17.6 billion is a serious number. But the catch with these stocks is usually the price tag. How much are we paying for that money machine?
That's the valuation reveal. We look at the enterprise value, which is the total cost to buy the business, so the market cap plus the debt minus the cash. That sits at roughly $96.9 billion.
Okay, so almost a $100 billion company.
Right. But if you divide that enterprise value by that estimated $17.6 billion in earnings...
You get the multiple.
Exactly. You get an EV to EBITDA multiple of just 5.5 times.
5.5 times. I mean, in a market where tech stocks trade at 30, 40, sometimes 50 times earnings, that sounds incredibly cheap.
Mm-hmm.
But is it cheap for a miner? Or is that just normal for this sector?
Yeah. Historically, for a major miner with these kinds of Tier 1 assets, that is a very favorable valuation. It suggests the market isn't fully pricing in the cash flow they are currently generating, let alone what they could generate if copper stays strong.
So the market is being pessimistic.
Exactly. It's priced as if copper is going to go back to $4, even though the structural demand from AI and electrification says otherwise.
It's cheap. But cheap can be a trap if the company is falling apart. We call that a value trap. You buy it because it's cheap, and then the core business just goes to zero. What are the operational tailwinds here? Why is the company actually in a good position, aside from the price of the metal?
There are two main factors that make this an operational story, not just a macro price story. First, you have the international operations, specifically Indonesia.
Right, the sources mention this, the Grasberg mine. This is legendary in the mining world, isn't it?
It is. It's one of the largest copper and gold deposits on the planet. But it's important to note the context. There was a tragic accident there last year, a fire at the smelter, which obviously impacted operations, and is a very somber reminder of the physical risks in this industry.
Yeah, dangerous work.
It is. But looking purely at the output, the company is recovering. They are significantly increasing output from those Indonesian assets over the next few years. That's volume growth.
So they're selling more copper, not just more expensive copper.
Correct. They are fixing the bottleneck and opening the taps.
But here is where it gets really interesting for me. I was reading through the notes on their leaching initiative. This feels like one of those things that sounds incredibly boring, leaching, but is actually kind of a superpower.
It is surprisingly fascinating. It's essentially a technology play disguised as a mining operation.
Explain leaching to me like I'm 12. Because when I hear leaching, I think of an old battery rotting in a drawer or something leaking in my fridge.
It's a bit more scientific than that. Think of it like this. Imagine you have a giant pile of rock that you've already mined over the last 20 years. You've already taken the easy copper out of it, the big chunks.
Right.
Historically, that pile is just waste. It sits there. It's a liability. But there is still copper trapped inside those rocks. It's just in low concentrations, maybe less than 1%. So it's historically been too expensive to grind it all up again to get it.
It's the leftovers. The crust of the pizza.
Right. Leaching is a chemical process. Freeport is actually using new proprietary technologies involving heat and specific bacteria bioleaching, where they essentially irrigate that pile of waste rock. They drip a solution over it.
And what did that do?
The solution dissolves the remaining copper, gravity pulls it down, and they catch the copper-rich liquid at the bottom.
So you're just squeezing the sponge.
Exactly. But here is the economic magic. You have already paid to mine the rock. The rock is already sitting right there on the surface.
Oh, wow.
You don't need trucks, you don't need crushers, you don't need a permit to dig a new hole, you don't have to fight for land rights.
So the cost to produce this copper must be what?
It's incredibly low. It has almost zero capital intensity compared to digging a new mine. The margins on this waste copper are spectacular.
It's essentially free copper. Well, discount copper.
High margin copper. And here is the aha moment from the data. Management has already baked some of this into their guidance. They assume they'll get about 250 to 300 million pounds of copper from leaching in 2026.
Okay, that's a lot of copper.
It is, but they expect to hit 400 million pounds in 2027, and their goal is to ramp that up to 800 million pounds by 2030.
Wow. 800 million.
And the key point the analyst makes is that this ramp up, that extra 400 or 500 million pounds, is not currently fully priced into the guidance. It's hidden upside.
That is massive. We're talking about nearly 1 billion pounds of copper coming from waste piles. That changes the math completely.
It does. It provides a massive buffer. Even if copper prices dip slightly, they are increasing their low-cost production volume so much it offsets it. So you have a cheap stock, strong prices, and a hidden volume expansion mechanism.
That is why it's called asymmetric value. You aren't paying for the leaching upside, but you get it for free.
Precisely.
All right, so that's the Copper King. Now let's pivot. Let's talk about the metal that everyone loved, that everyone hated, and now, well, we aren't sure. Lithium.
Ah, the lithium winter.
It sounds like a bad fantasy novel. The lithium winter. But it was very real for investors, wasn't it? I know people who bought Albemarle, ticker ALB, back in 2022, and they are still crying when they open their brokerage app.
It was brutal. We saw a massive crash in lithium prices. It was a classic capital cycle bust.
What actually caused it? Because for a while there, it seemed like lithium was the only thing that mattered. Every car company was pledging to go fully electric. We were told there was a massive structural shortage.
It was a classic boom and bust. During the pandemic, there was this massive boom in expectations for electric vehicles. Prices for lithium skyrocketed because everyone thought we would run out, so miners rushed to produce more.
Naturally.
But then supply came online just as EV investment slowed down. It didn't stop, but it cooled off significantly due to interest rates and consumer hesitation.
So a wall of supply hitting a market that was suddenly taking a breath.
Exactly. It's called destocking. Battery makers stopped buying because they had too much inventory sitting in warehouses. Albemarle, being the industry leader, took it on the chin. Their income dropped sharply starting in 2022. They actually reported real losses in 2024 and 2025.
Ouch. So if they are losing money, why are we talking about them as a value play? Usually value investors want companies that are making money now. Investing in a company losing money sounds like gambling.
Because of the pivot. And because markets are forward-looking, management didn't just sit there and watch the stock price fall. They reacted. They divested non-core businesses, got rid of the distractions, they cut costs aggressively.
Right.
They leaned out the operation to survive the winter, they halted expansion projects to save cash.
They hunkered down? They put on their winter coats?
They did. And now we're looking at 26 projections with a much leaner, more efficient company.
Let's look at the math again. We're using the price of lithium carbonate equivalent, or LCE. Where are we in early 2026?
In January 2026, the average price was around $20 per kilogram.
Is $20 good? I mean, compared to the peak?
It's nowhere near the peak. The peak was absolute insanity, something like $80. But $20 is a stabilizing level. It's a healthy level where miners can make money, but it doesn't kill consumer demand. The argument from the source is, if that $20 price just holds steady through 2026, no massive boom, just stability, Albemarle is projected to earn between $2.4 billion and $2.6 billion in EBITDA.
Okay. So they swing from a loss back to a pretty healthy profit. And what's the price tag for the company?
The enterprise value is sitting around $23.5 billion.
So doing the math.
It comes out to an EV to EBITDA ratio of roughly 9.4 times.
9.4. Now, compared to Freeport's 5.5, that sounds a bit more expensive.
It is higher than Freeport, but you have to look at the context. You are buying a premier asset, probably the best lithium asset portfolio in the world, coming out of a cyclical bottom. 9.4 is considered excellent value for a turnaround story. You aren't buying peak earnings, you're buying the start of the recovery.
So the core bet is that the lithium winter is officially over.
That's the thesis. The supply glut appears to have cleared out. The weaker players went bust or stopped producing because they couldn't make money at these prices. And on the demand side, things are heating up again.
EV investment is growing again, right? I feel like I'm seeing more ads, more models on the road.
It is growing low below, especially in China and Europe. But there is another factor that the source highlights, which I think is absolutely crucial. It's not just about cars anymore. We need to talk about BS.
BES, battery energy storage systems.
Correct. Grid storage. This is the silent giant of the lithium market. As we add more solar and wind to the power grid, we have a fundamental physics problem. The sun doesn't shine at night, and the wind doesn't always blow. We need massive utility-scale batteries to store that energy.
And those batteries need lithium.
Tons of it. Specifically, they use LFP lithium iron phosphate batteries. This sector is absolutely surging right now. It's becoming a massive second pillar of demand alongside EVs.
Wow.
So you have a leaner Albemarle, a stabilized price, and two massive demand drivers kicking in for 2026.
That makes perfect sense. It's diversifying the risk. If car sales slow down, the grid storage build-out might speed up. It makes the floor under the price much more solid than it was 3 years ago.
Exactly. The demand is structurally sound.
So we have Freeport as this cash-generating monster with hidden upside, and Albemarle as the lean, mean turnaround machine. It sounds like a slam dunk. Why wouldn't I just put my whole portfolio in this?
Well,
Oh, I hate that well. That well usually means I'm not buying a yacht next week.
we have to apply some critical thinking here. We have to look at the counterpoint. We need to distinguish between value and growth. Because if you buy this expecting it to act like a tech stock, you might be severely disappointed.
Okay, let's hear it.
We have a very interesting data point from the Motley Fool Stock Advisor team, dated February 22nd, 2026.
Fresh data. What did they say?
They released their list of the 10 best stocks to buy now. And guess who was not on that list?
Albemarle.
Albemarle was not on the list.
But wait, we just spent 10 minutes explaining why it's unmissable value. Are they seeing something we aren't?
It's not that they dislike the stock, it's that the Stock Advisor Top 10 list has a very specific goal. They are hunting for monster returns. We're talking 10 baggers.
10 baggers.
Yeah.
Stocks that go up 1,000%.
Right. They reference historical picks like Netflix in 2004 or Nvidia in 2005 or Tesla in 2012, which is up some insane 19,000%.
Okay, so they are looking for the next NVIDIA. They want the company that changes the world and scales infinitely.
Exactly. And a mining company, even a truly great one, like Albemarle, is incredibly unlikely to give you 1,000% return in a short period. It's a physical commodity business.
That's laws of physics apply.
Right. It requires massive capital. You have to buy trucks, dig holes, process rock. It's not software that you can scale to 1 billion users with zero marginal cost.
So the nuance here is Albemarle is a solid bet for asymmetric value. Low risk, good reward. But it's probably not going to buy you a private island in 3 years.
Correct. It plays a completely different role in your portfolio. It's the defensive growth, the steady compounder. And this brings us back to our main theme. It's important to remember that the 10 baggers of the tech world literally cannot exist without the companies we are discussing today.
Right. The indispensable monopoly argument.
Precisely. NVIDIA, Intel, the entire AI infrastructure, none of it functions without copper for the wires and cooling systems, and lithium for the backup power storage. You can't have software without hardware, and you can't have hardware without metals.
It's the classic selling shovels in a gold rush scenario, except here we're selling the copper that makes the gold rush possible. And unlike shovels, you can't just make them out of wood if you run out of metal. Physics is physics.
And that is exactly why, even if they aren't the flashiest stocks on the top 10 list, they represent a fundamental layer of the economy that is currently trading at a massive discount. If you believe in AI, if you believe in the energy transition, you implicitly have to believe in copper and lithium demand.
That's a great way to frame it. You can chase the high-flying tech stocks, but having a floor of physical assets, especially ones trading at 5 times or 9 times earnings, seems like a really smart hedge. It balances the portfolio.
It's all about balance.
So what does this all mean for you listening right now? Let's recap the main takeaways before we sign off.
Takeaway 1 is Freeport-McMoRan. You've got a copper giant trading at a historically cheap 5.5 5 times multiple. But the real kicker, the thing the market is missing, is the leaching technology. They're unlocking massive amounts of copper from waste rock, potentially 800 million pounds by 2030, that essentially comes with zero capital cost.
It's free optionality. And takeaway two is Albemarle. The lithium winter appears to be thawing. The company has cut costs, leaned out, and is trading at a fair 9.4 times earnings. With lithium prices stabilizing at $20 a kilo and the rise of grid storage, BES0, the demand floor is much higher than it was just a few years ago.
Exactly. Investing in these isn't about chasing the latest meme stock. It's a bet on the physical infrastructure of the future. It's acknowledging that AI and renewables are heavy industrial processes that need raw materials.
And that brings me to a final thought I want to leave everyone with. It's something that really stuck with me about the leaching story we talked about earlier.
The waste rock.
Yeah. We usually think of mining as discovery. You go out, you find a new deposit in the mountains, you dig a hole. It's exploration. It's Indiana Jones. But Freeport is showing us that the biggest value might not be in finding new things.
That's a really profound shift in mindset.
Right. If technology allows us to extract billions of dollars of value from the trash piles of the last century, are we entering an era where the definition of a mine changes entirely?
It's a fascinating question. We are moving from an era of pure extraction to an era of hyper-efficiency. Perhaps the most valuable commodity assets of 2030 aren't in some remote, unexplored jungle. Maybe they're just sitting in the heap outside the processing plant we built in 1990.
The treasures in the trash. Something to think about next time you take out the recycling. Thanks for diving in with us today.
Always a pleasure.
Keep digging, everyone. We'll see you next time.